You just got your paycheck. You open your banking app. You see that direct deposit hit, and you do what every personal finance guru has told you to do. You immediately transfer money to your 401k. Max out your Roth IRA contribution for the month. Maybe put some into an index fund. You are being responsible. You are doing it right. And then 2 weeks later, you are checking your checking account balance before buying groceries, because you are not entirely sure if you have enough to cover everything until the next paycheck. Meanwhile, there is this other group of people who somehow seem to have money for everything, who never seem stressed about cash flow, who are building wealth faster than you, despite apparently spending more freely. And here is what nobody's telling you. They're doing everything in the exact opposite order that you've been taught. My name is Jod, and I spend way too much time thinking about why conventional investment advice creates cash, poor, asset, rich people who are stressed about money despite doing everything right. If you are someone who has been diligently investing, but still feels broke at the end of every month, make sure to hit the subscribe button and give this helps you out. Because here is the thing. The investment sequence you've been taught, the one that says pay yourself first and automatically invest before you can spend, that advice is creating a specific kind of financial prison. And I am going to show you exactly why the wealthy do it backward. And why that reverse order is what actually builds both wealth and freedom. The conventional wisdom that is killing your cash flow. Look, let me start by saying something controversial. Pay yourself first is incomplete advice that has been bastardized from its original meaning. The traditional advice goes like this. Paycheck hits 401k contribution automatically deducted Roth IRA transfer on the first of the month. Maybe some to a brokerage account then you lift. And here is what happens in real life. You've got 4,200 hit your account. 630 goes to your 401k 15. 500 goes to your Roth IRA. And suddenly you are living on 3,070 for the month. Rent is 1,400. Car payment is 350. Insurance is 200. Utilities is 150. Groceries are 400. That leaves you with 570 for everything else, guys. Going out, unexpected expenses. Literally everything else in your life. So what happens? You end up using a credit card for that car repair. You finance that emergency dental work. You can't take advantage of opportunities because you are technically building wealth while being functionally broke. Here is what most people don't realize. The wealthy don't do this. They never put themselves in a position where their investments create cash flow stress. Never. The reverse order, and why it actually works. Here is where it gets really interesting. The reverse order looks like this. 1. Build your cash position first. Liquid accessible money. 2. Create your opportunity fund, medium-term accessible investments. 3. Only then lock money into long-term retirement accounts. 4. Finally, pursue tax-advantaged investing. I know what you are thinking, Jod. This is backwards. I am missing out on compound interest. I am losing tax advantages. This is insane. But let me show you the math, because this is where everyone gets it wrong. The math, nobody shows you. Let's compare two people, both making $75,000 a year. Person A, traditional method, immediately maxes 401k, 23,000 yay. Maxes Roth IRA, 7,000 year. Total invested, 30,000 year. Take home after investing, 45,000. Roughly after taxes, living on 3,750 month. Emergency fund, 4,000 took 2 years to save, because everything went to retirement. Credit card debt from emergencies, 6,500, at 19.99 interest. Person B, reverse method. Year 1, invests only 500 month, 6,000 year, into retirement. Aggressively builds cash reserves, 2,000 month. After 10 months, has 20,000 in liquid savings. Year 2, maintains 15,000 cash cushion, redirects additional to taxable brokerage, 1,500 month. After 18 months, has 15,000 cash, 18,000 in accessible investments. Year 3, Now ramps up 401k and Roth IRA contributions. Credit card debt, zero. Stress level significantly lower. Here is the thing. Person A is theoretically building wealth faster in years 1 to 3. They're getting that tax-advantaged compound growth earlier. But here is what actually happens in real life. Person A faces an emergency in month 14. Their car needs a $2,800 repair. They have $4,000 in savings, but using $2,800 of it would leave them with only $1,200 in emergency funds, which terrifies them. So they put it on a credit card. That $2,800 at 19.9 the 9th of April cost them $560 in interest over the year, because they can only make minimum payments while maintaining their aggressive investment schedule. Person B faces the same emergency. They have $20,000 in cash. They pay the $2,800 immediately. They rebuild that $2,800 within 2 months. No interest paid. No stress. No derailing of their financial plan. Over a 10-year period, Person A's emergency-driven debt and forced investment liquidations, often at the worst times, actually result in lower net worth than Person B, despite Person B's slower start. A study from the National Bureau of Economic Research found that households that prioritized liquidity before long-term investing had 34 lower financial stress markers and were 2.1 times less likely to carry high-interest debt. Lower stress, better decisions, more wealth. The opportunity cost you are not calculating. Look, here is something that changed everything for me when I finally understood it. Every dollar you lock into a 401k or IRA before you have substantial liquid assets is a dollar that can't capitalize on opportunity. Let me give you a real example. Your friend is selling a car worth $8,000 for $5,500 because they need cash quickly. If you have liquidity, you buy it, sell it for $7,500 within a month, and pocket $2,000. That is a 36% return in 30 days. A promising investment opportunity comes up maybe. A friend's business needs a small cash infusion for equipment. That'll double their capacity. You could turn $10,000 into $15,000 in 6 months with minimal risk, because you know this person and their business model. Your company announces a stock purchase plan, where employees can buy shares at a 15% discount. That is an immediate 15% return, the day you buy it. But you can't do any of this, because all your money is locked in retirement accounts that you can't touch without penalties. Here is what most people don't realize. The wealthy stay liquid specifically to capture opportunities that generate returns far beyond index fund averages. Then they use those gains to fund their long-term investments. The psychological advantage. This is huge. Here is the part that nobody talks about, but is maybe the most important piece. When you invest in reverse, you completely change your psychological relationship with money. Traditional method. You are always in scarcity mode. You've done the right thing by investing, but you feel broke. You resent your savings because it feels like sacrifice. When life happens, you feel trapped. Reverse method. You have options. You sleep better. You make decisions from abundance rather than desperation. And here is the kicker: you actually invest more over the long run, because you are not constantly fighting psychological resistance. There is a concept in behavioral economics called decision fatigue under financial stress. When you are constantly worried about cash flow, every financial decision becomes agonizing. Should I invest more? Should I keep this in cash? Can I afford this? The stress literally impairs your decision-making ability. But when you have liquidity, decisions become clearer. You are not making fear-based choices. You are making mathematically optimal choices. The tax myth that keeps you trapped. Now, you might be thinking, but Jod, I am losing out on massive tax advantages. My 401k contributions are pre-tax. My Roth IRA grows tax-free. How can giving that up possibly make sense? Here is the thing. Tax advantages are only valuable if you are actually building sustainable wealth. And if tax-advantaged investing is creating a situation where you are accumulating debt, missing opportunities, and operating under constant financial stress, those tax benefits are costing you more than they're saving you. Let me show you the actual math. Scenario A. You put 6,000 into a traditional 401k, pre-tax. At a 22 tax bracket, you save 1,320 in taxes. That 6,000 grows to 11,760 in 10 years at 7 annual returns. Scenario B. You pay the taxes, 1,320, invest 4,680 in a taxable brokerage account. But because you have liquidity, you are able to capture just 2 medium-sized opportunities over those 10 years that generate an additional 8,000 in gains. Your total, 19,200. The opportunities you can capture with liquidity often dwarf the tax savings you are getting from retirement accounts. And here is something else. When you are not stressed about money, you perform better at work. You are more likely to negotiate raises. You are more likely to take calculated career risks that increase your income. A stress-free person earning 85,000 is building more wealth than a stressed person earning 75,000 and maxing out all tax-advantaged accounts. The three-phase system. All right, look. Here is the actual system that works. Phase 1, the foundation, months 1 to 12. Your only goal is cash accumulation. You need 20,000 to 30,000 in a high-yield savings account. That is it. Yes, you are missing out on investment growth. No, you are not screwing up your future. You are building a foundation that makes everything else possible. During this phase, invest only enough to get your full employer 401k match. If you have one that is free money, you can't leave on the table. But everything else, cash. I've seen people build this foundation in 8 to 12 months by cutting expenses temporarily and maybe adding a side income stream. It is not forever. It is a sprint to create permanent stability. Phase 2. The bridge, months 13 to 30. Now you maintain your cash foundation, but start building your opportunity fund in a taxable brokerage account. This money goes into simple index funds, total market, SP 500, whatever. It is invested, it is growing, but it is accessible without penalties if you need it. Your target, another 30,000 to 50,000 in accessible investments. Here is what this does. It gives you investment exposure and growth, while maintaining flexibility. You are participating in market gains, but you haven't locked yourself into a liquidity. Phase 3, the acceleration, month 31. Now you start aggressively ramping up retirement contributions. You've got 50,000 in accessible assets. You can weather storms. You can seize opportunities. Now you can afford to lock money away for decades. This is when you max out 401k contributions, max out IRAs. Start thinking about backdoor Roth conversions and advanced tax strategies. But you are doing it from a position of strength, not desperation. The real-world result. Here is what this actually looks like in practice. I know someone who followed this exact sequence. Year 1, they built up 25,000 in cash while contributing only 5 to their 401k email for the match. Everyone thought they were crazy for not maxing out tax-advantaged accounts. Year 2, they kept 20,000 in cash and started building a brokerage account. They put 1,500 a month into index funds. By the end of year 2, they had 20,000 cash, 22,000 in accessible investments. Month 26. A real estate opportunity came up. House was being sold below market value by someone who needed to relocate quickly. They used 35,000 as a down payment, bought the house for 180,000 worth 215,000, rented it out, and sold it 14 months later for 228,000. After costs, they netted about 52,000. That 52,000 gain funded 3 full years of maxed out 401k and Roth IRA contributions, while still maintaining their liquid position. Meanwhile, their friend who had been maxing out retirement accounts from day one had 95,000 in their 401k after those same 3 years. Sounds great, right? Except they had only 6,000 in accessible savings, carried 8,000 in credit card debt from emergencies, and missed that real estate opportunity entirely. Who is actually in a better financial position? The person with 95,000 locked away and 8,000 in debt, or the person with 60,000 in retirement accounts? 25,000 in accessible investments, 15,000 in cash, and zero debt. The career insurance nobody talks about. Look, here is another massive advantage of the reverse order. Liquidity is career insurance. If you have 40,000 in accessible assets, you can quit a toxic job without another one lined up. You can negotiate from a position of strength. You can take a lower paying position in a field you actually want to be in because you have a runway. I've watched people stay in Seoul, crushing jobs for years because I can't afford to levy, need the 401k match, and the benefits. They're trapped by their own retirement accounts. But people who build liquidity first, they have options. And having options means you can optimize for long-term career growth instead of short-term survival. There is data on this. A study from the Journal of Vocational Behavior found that employees with high liquidity 3 months of easily accessible savings investments were 2.3 times more likely to make career changes that resulted in higher lifetime earnings. Your career trajectory is worth more than any tax advantage. What to actually do right now? Alright, here is your action plan. If you are currently in the traditional method, don't panic. Don't liquidate your retirement accounts, but do pause and evaluate. If you have less than 15,000 in easily accessible money, cash taxable investments, consider temporarily reducing your retirement contributions to the employer match level only. Use the difference to aggressively build liquidity. This might feel wrong. It might feel like you are going backward, but you are not. You are building a foundation that makes everything else sustainable. If you are starting from scratch, phase 1 is your only focus. Get to 20,000 to 25,000 in cash before you do anything else except capturing employer match. Track this weekly. Make it visible. This is the foundation of your entire financial life. If you are already past phase 1, evaluate your opportunity fund. Do you have 30,000 in accessible investments? If not, that is your phase 2 goal before you ramp up retirement contributions. The truth about timing. Here is what I really want you to understand. The conventional wisdom assumes you have 40 years to invest, and that consistency is the only thing that matters. But life doesn't work that way. The opportunities that actually change your financial trajectory happen in specific windows. A business opportunity, a real estate deal, a career move. These don't wait for you to reach age 59. The wealthy understand this. They optimize for optionality first, tax efficiency second. And here is the thing. Once you have liquidity, and you've captured a few opportunities, you end up with more money to put into tax advantaged accounts anyway. You are not choosing between liquidity and retirement investing. You are sequencing them in the order that actually builds sustainable wealth. Look, the financial services industry doesn't want you to know this, because their business model depends on you locking up your money where they can. Charge management fees for decades. The conventional advice of max out all retirement accounts immediately serves their interests, not yours. But the people who actually build wealth, they stay liquid. They stay flexible. They build their foundation first, then they build their empire. And the weird thing is, when you do it this way, the stress disappears. Money stops being this constant source of anxiety and becomes a tool you actually control. So wherever you are at right now, give yourself permission to do this backward. Build cash first. Build opportunity funds second. Lock into long-term accounts third. The wealthy have been doing it this way forever. They just don't advertise it, because maintaining information asymmetry is how they stay wealthy. If this completely changed how you think about investing and you want more content that breaks down what actually works versus what you've been told works, make sure you are subscribed. I'll see you in the next one.